You're watching resistance all morning. Price finally breaks through with a massive green candle. You jump in thinking, this is it. Then, boom. Price reverses hard and stops you out like it was all just a trap. Sound familiar? This is called a fake out. And if you're nodding right now, you're not alone. We've all been there, but here's what changed everything for me. Fake outs aren't random. They're not bad luck. There's actually a method to the madness, and once you understand it, you can start avoiding these traps completely. Today, I'm going to show you exactly how to spot real breakouts versus the fake ones. Pure price action. No fancy indicators, no magic formulas. Just you, the chart, and some street smarts. First, let's get clear on what a breakout actually is. A breakout is when price moves beyond a key level, support, resistance, trendline, or chart pattern, and keeps going with strength and follow-through. Think of price like a pressure cooker. The market builds up tension, buyers and sellers battling it out, until finally, the pressure is too much. It explodes out of the zone. That's a breakout. But the key word here is conviction. A real breakout doesn't just tiptoe above a level and hesitate. It rips through it like it means it. The problem? Most traders confuse a poke with a breakout, and that's where fakeouts come in. There is also called stop loss hunt, which is deliberately hunt your stop loss by the big institutions. I have a separate video on this topic. Check it out in this channel. So now that we know what a breakout actually is, and that it's more than just price popping above a line, the next question becomes, where do these breakouts tend to happen? What makes certain price areas more meaningful than others? That's where key levels come into play. Support, resistance, and trend lines. These aren't just lines on a chart. They're the zones where traders make decisions, where the market reacts, and where real breakout opportunities form. Support is where price tends to stop falling. It's that zone where buyers step in and say, that's cheap enough. On the flip side, resistance is where price tends to stop rising. Sellers step up and say, that's high enough. These levels often align with previous swing highs and lows, especially the ones that have been tested multiple times. Now, not all levels are created equal. Some are horizontal, like old highs or lows, or even psychologically important numbers like 100, 500, or round price levels. Others are diagonal. These are your trend lines, sloping upward in uptrends or downward in downtrends. A valid trend line usually needs at least 3 touch points to be considered reliable. And then there are dynamic support and resistance levels, moving averages like the 50 or 200 period. They shift as price evolves and often act as magnet zones where price reacts in trending market. But here's where things get really interesting. When multiple levels converge, like a horizontal resistance, a trend line, and a moving average all meeting at one price area, that's called confluence. And it creates zones where market participants are heavily focused. If price breaks through a confluence zone, it carries way more weight than breaking a single isolated level. That's the kind of breakout traders pay serious attention to. Patience here is key. Many failed trades come from jumping in too early due to FOMO, the fear of missing out. But the traders who wait for confirmation often end up with higher probability entries and better risk-reward setups. Now that we understand what support and resistance is, let's talk about what usually comes before that breakout. The chart patterns. Think of these patterns like the market's body language. They don't shout, but they give us clues, signals that a big move might be around the corner. And broadly speaking, these patterns fall into 2 main categories: consolidation patterns and reversal patterns. Let's start with consolidation patterns. These show up when price action begins to contract, trading in tighter and tighter ranges. It's like a coil being wound up, getting ready to spring. These are often the calm before the storm. One of the most common consolidation structures is the triangle. Now, triangles come in a few flavors. Symmetrical triangles happen when both buyers and sellers are backing off. Price starts to compress between 2 converging trend lines. The breakout could go in either direction, but when it does, it usually picks up momentum fast. Then we have ascending triangles, which are a bit more bullish in nature. In this case, price keeps bumping into the same resistance level at the top, but the lows keep getting higher, meaning buyers are getting more aggressive. These patterns often break to the upside. The flip side is the descending triangle, where the bottom stays flat and the highs get lower. This one tends to break down, showing sellers are taking control. Another classic setup is the rectangle, or trading range. Here, Price is bouncing between two clearly defined levels, support and resistance, without committing to either. It looks boring on the surface, but rectangles can lead to strong breakouts once the balance tips. That said, they're also notorious for fakeouts, so caution is key. Then we've got flags and pennants. These show up right after a sharp move. Imagine price just shot up or down in a burst, and then it pauses, pulls back a bit, or moves sideways. That pause forms a small flag, or a pennant. Flags are more like parallel channels, while pennants are little triangles. Either way, once price breaks out of them, it usually resumes in the same direction as before. Wedges are similar, but they're a bit sneaky. These are consolidations where both trend lines slope in the same direction. A rising wedge, even in an uptrend, can actually be bearish, while a falling wedge can be a bullish reversal pattern. It all depends on context. Now let's shift gears to reversal patterns. These are the ones that suggest the current trend might be coming to an end and something new is about to begin. You've probably seen the double top or double bottom. Picture price hitting the same level twice and failing both times. That's a double top if it happens at resistance, and a double bottom if it's bouncing from support. The key confirmation is when price breaks the level in between those two peaks or valleys, often called the neckline. A more dramatic version is the triple top or triple bottom. This time, price tests the same level 3 times. When it finally gives way, the move can be explosive. But these setups are a bit rarer. Now here comes a fan favorite, the head and shoulders pattern. It's easy to recognize once you've seen it a few times. Picture 3 peaks where the middle one, the head, is the highest, and the 2 outside ones, the shoulders, are slightly lower. When price breaks the neckline that connects the 2 lows between the peaks, it often signals a strong reversal to the downside. There's also the inverse head and shoulders, which flips the whole structure and signals a bullish reversal instead. Lastly, there's the cup and handle pattern. This one's popular in swing trading, but you can spot it intraday too. Imagine a rounded bottom, like a teacup, followed by a short, shallow pullback that forms the handle. When price breaks above the top of that cup, it usually means buyers are ready to push again. Now, before we move on, let me be clear about something. Just spotting these patterns isn't enough to place a trade. Patterns are just context. They set the stage. What really matters is the breakout itself, and whether the market follows through or fakes you out. Now that we've mapped out where breakouts are likely to happen, whether at key support and resistance levels, major trend lines, and patterns, you might think you're ready to jump in. But hold on, because not every breakout is the real deal. Some are traps, carefully crafted by the market to lure in breakout traders only to snap back and reverse hard. These are called fake breakouts or false breakouts. And if you're not careful, they'll chew through your stop losses before you even know what hit you. Let's walk through the most common signs that a breakout might be fake, so you can avoid the trap and wait for confirmation like a pro. First, the spike in reverse. One of the clearest red flags is what traders call a spike in reverse. You'll see price suddenly surge through a level, maybe even with a big bullish candle. But instead of holding above it, it snaps right back below with strength. It leaves behind a long wick and little to no body. That wick? It's the footprint of stop losses getting swept. Breakout traders pile in, the market runs their stops, and then reverses. Classic trap. Second, no follow through after the breakout. So let's say a candle breaks out cleanly. Strong body, decisive, close above resistance. It looks like the real deal. But here's the catch. The following candles doesn't go anywhere. Instead of building momentum, price starts stalling, chopping, or even pulling back. This is what we call no follow through. The breakout had an initial spark, but zero fuel to keep it going. This is a red flag. When a breakout doesn't get immediate follow-up buying or selling pressure, it's often a sign that the move was premature. Or worse, a trap. Smart traders step back and wait for confirmation before chasing it. Third, weak breakout candle close. This one's different. A weak close means the breakout is failing right from the start. You'll see price push above the breakout level during the candle. It pokes its head out, but by the time the candle closes, it's pulled back in. The body is small, the wick is long. It shows hesitation, not conviction. This tells you the breakout isn't real, at least not yet. It's just price testing the level, not breaking through it with strength. So if you're jumping in just because price pierced a level intrabar, you're front running the move and setting yourself up to get faded. Fourth, low volume or bad timing. Even a clean price break can be misleading if it happens during low volume periods, like lunch hours, Asian session in Forex trading, or right before a major economic release. Volume is the fuel of breakouts. Without it, the move lacks participation. And if the breakout happens when most big players are asleep, high odds it won't hold. Fifth, when it's too obvious. Strangely enough, the more textbook perfect a breakout setup looks, the more likely it is to fail. Why? Because everyone sees it, and when the whole crowd piles into the same trade, the market often punishes that consensus. Smart money loves to push price just far enough to trigger stop orders, then reverse in the opposite direction. So don't blindly trust the obvious. Dig deeper. Sixth, the retest that fails. We talked about how a proper retest confirms a breakout, but if price retests the level and doesn't hold, if it slices right back through without a bounce, that's a major warning sign. Remember, support becomes resistance, and resistance becomes support. If that flip doesn't hold, the breakout is not valid. It's just noise. Fake breakouts are designed to test your patience, your discipline, and your ability to wait for confirmation. They exploit FOMO, lure in impulsive traders, and punish anyone chasing moves without real context. In the last chapter, we broke down what fake breakouts look like, how they trap traders with sudden reversals, low conviction, and lack of follow-through. But knowing what a fakeout is only half the battle. Now let's talk about how to avoid getting caught in one. This is the real skill, separating the traps from the opportunities. Here's my price action playbook for identifying high probability breakouts and staying on the right side of the move. We begin with rule number 1. Wait for a strong close. Just because price touched a breakout level doesn't mean it broke through it. One of the most common mistakes is entering too early during the candle, only to get caught in a reversal before the bar even closes. Instead, wait for a full candle to close decisively, above resistance or below support. The ideal breakout candle has a full body, very little wick, and clear directional momentum. That's conviction. That's what real breakout pressure looks like. If you're going to trust a breakout, make sure the market has spoken clearly, not in whispers, but with authority. Next up, a classic, the retest entry. After a breakout occurs, don't rush in immediately. Let price pull back and test the broken level. This is where the market decides, was that breakout real or just a head fake? If the retest holds and price bounces cleanly off the old level, that's your confirmation. You're not chasing the move anymore. You're trading with structure, with validation. Think of it like the market saying, yes, that level really did flip. This method filters out a ton of false breakouts and often gives you better entries with tighter stops. Yes, waiting for a retest reduces your risk, but sometimes price just runs without looking back, and you miss it. That's the trade-off. Now let's zoom out, align with the trend. This one's simple but powerful. Breakouts are far more likely to succeed when they're moving in the direction of the higher time frame trend. If you're trading a 5-minute breakout and the 1-hour chart is also trending in that direction, that's alignment. It's confluence. But if you're trying to buy a breakout against a higher time frame downtrend, you're swimming upstream. And in trading, the river usually wins. Always check the bigger picture before committing to the breakout you see on the small chart. Then there's a subtle but critical filter. Avoid breakouts from the middle of nowhere. If price is sitting in the middle of a range with no clear support or resistance nearby and suddenly breaks out, be careful. That's often just noise, not structure. Here, often the price will hit first your stop loss and then profit target. That's feeling you know. Real breakouts come from well-defined levels. Clean highs, clean lows, multi-tested barriers. If there's no structure to break from, there's no structure to break through. So skip the vague, middle-of-nowhere breakouts and wait for ones that are anchored in real, visible price history. Another key factor, timing. Not all breakout environments are equal. The best breakouts typically happen when volume is active, during major trading sessions like the New York Open or the London Overlap. These are the times when institutional players are active, when order flow is real, and when breakouts are more likely to run. On the flip side, breakouts during dead hours, like lunchtime or Asia's late session, often lack follow-through unless a major catalyst is in play. So trade when the market is alive, not when it's sleepwalking. Finally, and this one is non-negotiable, always define your risk. No matter how good a breakout setup looks, you need a clear stop-loss level. That stop should go outside the structure, not inside the breakout candle itself. Why? Because if the breakout fails and price re-enters the previous range, you want to be out quickly, not stuck hoping. Professional breakout traders know this. The key to consistency isn't just in identifying breakouts, it's in protecting capital when they fail. And if you take a loss and still feel calm, that's a sign you're trading with discipline, not emotion. That's how you survive long enough to thrive. Breakouts are powerful, but only when you trade them with clarity, not emotion. After everything we've covered, from identifying structure, spotting key levels, understanding breakout patterns, to filtering fakeouts with price action, one thing becomes clear: patience wins. Not every breakout is worth taking. The best ones happen with strong structure, clean closes, aligned trends, and confirmation. No guessing, no chasing. Your job as a trader isn't to predict every move. It's to react when the odds are in your favor and stay out when they're not. So next time you see price pressing a level, remember, wait for confirmation, trust your process, and always define your risk. Missed trades are better than bad ones. Trade smart, trade patient, and let the breakout come to you. Thank you for watching.